Silver just moved more than 15% in a matter of weeks, slicing through resistance that had capped it for over a decade, only to reverse sharply and erase a third of those gains in days. Not months, not quarters, days. Traders were positioned for a breakout above $30 per ounce, a level not sustainably seen since 2013, and then volatility surged as if someone flipped a switch. They said the metal was too small, too illiquid, too forgotten to stage a structural move. They said the era of explosive commodity cycles was over. And yet, here we are, watching silver trade with the kind of range normally reserved for tech stocks during earnings season. Here's what makes this different. Institutions were already repositioning while retail was celebrating the breakout. Margin requirements shifted. ETF flows changed direction, open interest expanded, and then contracted at precisely the moments that mattered. What I'm about to show you isn't a prediction, it's a pattern. And patterns, when they repeat across decades, tell us more than headlines ever will. Welcome to Market Signal, where we decode financial shifts before they become consensus headlines. This channel exists for one reason, to track the data before it becomes narrative. Not after CNBC debates it, not after social media polarizes it. Before. If you appreciate calm, evidence-based breakdowns, think of this as sitting down with someone who reads the filings so you don't have to. And as always, let me know in the comments where you're watching from. This community spans continents, and silver, as you'll see, is a global story. In early 2024, silver did something it had failed to do for nearly 11 years. It broke above $30 per ounce with conviction. The move wasn't gradual. Futures volume on COMEX surged past 200,000 contracts during key sessions, well above average daily turnover. Exchange data showed open interest expanding rapidly as price climbed, a classic confirmation signal that new money was entering the market rather than shorts merely covering. At the same time, the gold to silver ratio compressed from above 90 to near 75. Signaling relative strength in silver that hadn't been sustained since the last commodity upcycle. Then volatility spiked. Within weeks, silver retraced double digits from its highs. Daily ranges expanded to over $1 per ounce in multiple sessions. ETF flows, particularly in major products tracking physical silver, shifted from steady inflows to abrupt net outflows. The CME adjusted margin requirements modestly during peak volatility, increasing the capital required to hold futures positions. That matters because leverage is the oxygen of momentum. When the oxygen gets thinner, price moves change character. Here's the central mystery. Physical coin premiums reported by major dealers remained elevated even as futures prices corrected. Industrial demand projections tied to solar panel manufacturing and electronics fabrication remained stable in public earnings releases. So why did the paper price retreat so aggressively if the underlying demand narrative hadn't collapsed? That divergence is where the real story begins. This is not the first time silver has behaved this way. In 2010, silver broke out of a long consolidation range near $20. Volume surged. Retail interest exploded. By April 2011, the metal touched nearly $50 per ounce. Then just as rapidly, it collapsed more than 30% in a matter of days after a series of margin hikes on the futures exchange. The pattern was clear. Rapid ascent fueled by leverage, margin adjustments, forced liquidation, volatility cascade. Go back further. In 2006, silver rallied from around $7 to over $15 within a year, only to experience a violent correction of roughly 25% before resuming its climb. In 1980, during the famous precious metals spike, silver surged to nearly $50 and then fell below $11 within months after exchange, rule changes, and liquidity contractions. Different decades, different macro backdrops, same structural sequence. Breakout from multi-year base, surge in speculative positioning. Institutional response through margin or liquidity shifts. Violent pullback, then either continuation or prolonged consolidation, depending on broader liquidity conditions. Now in 2024, silver again broke from a base that had held since 2013. The base itself is significant. 11 years of compression represents stored energy. Volatility measures for silver had been subdued relative to historical norms. When assets compress for that long, moves tend to be nonlinear when they finally release. The data shows that multi-year commodity bases rarely resolve with quiet, incremental steps. They expand in volatility first. Direction comes second. Let's talk about the players. JP Morgan, historically one of the largest participants in precious metals markets, is both a bullion bank and custodian for major ETFs. Public filings showed adjustments in ETF holdings during peak volatility windows. BlackRock's iShares, Silver Trust experienced fluctuations in reported ounces held, reflecting changes in investor positioning. Meanwhile, CME Group, which operates COMEX, implemented margin requirement updates during the most volatile stretch, increasing the initial margin per silver futures contract by several percentage points. At the same time, U.S. Mint reports indicated intermittent constraints in silver coin supply earlier in the year due to elevated demand. Industrial players, particularly in the solar sector, continue to reference silver as a critical input in photovoltaic cell production. None of these entities are coordinating publicly, but the timing of their actions intersects. Futures leverage expands, price accelerates, margin requirements rise, ETF flows reverse, retail enthusiasm cools, the sequence repeats with mechanical precision. This is where it gets interesting. Paper silver trades in enormous volume compared to physical delivery. Daily notional turnover in futures often represents hundreds of millions of ounces, far exceeding annual mine production. Most contracts never result in physical exchange. They are financial instruments. So when volatility surges and margin requirements increase, leveraged participants must either post additional capital or liquidate. The forced selling can push paper prices lower even if underlying physical demand remains steady. Now layer in the dislocation. During the recent pullback, futures prices corrected sharply, but premiums on popular retail coins did not collapse proportionally. In some cases, dealers continued to charge several dollars above spot. Meanwhile, the gold-to-silver ratio, though off its lows, remained well below the extremes seen in prior years. Two signals, one market suggesting cooling momentum, another suggesting sustained underlying tightness. These cannot diverge indefinitely. Historically, when paper and physical dynamics diverge, resolution comes through one of two paths. Either physical demand weakens and premiums normalize downward, validating the future's correction, or paper prices rebound to reflect continued structural demand. In 2011, after the margin-driven collapse, silver consolidated for years because broader liquidity tightened and commodity enthusiasm faded globally. In contrast, during 2006 to 2008, corrections were followed by renewed advances as macro liquidity expanded. So what mechanism drives this volatility? Think of the futures market as a highly leveraged seesaw. On one side are longs betting on higher prices. On the other are shorts hedging production or speculating on declines. The fulcrum is margin. When prices rise quickly, longs gain equity and may add positions. Shorts face losses and must post collateral. If volatility exceeds thresholds, the exchange raises margin requirements to maintain systemic stability. That effectively increases the weight on both sides. Participants with thinner capital cushions are forced off the seesaw. When they exit, price can swing violently in the opposite direction. In the recent episode, open interest expanded during the rally, indicating new positions rather than simple short covering. As volatility accelerated, margin adjustments and profit-taking reduced open interest. That contraction suggests positions were unwound. The cause and effect chain is mechanical, not emotional. Breakout attracts leverage. Leverage increases fragility. Fragility meets volatility. Volatility triggers margin response. Margin response forces liquidation. Liquidation amplifies price swings. But here's what most people miss. Volatility expansion. After a multi-year base is not inherently bearish. It is a transition phase. The market is discovering equilibrium at a new range. In every major silver cycle, initial breakouts were messy. In 2010, the path from 20 to 50 was not linear. There were multiple double-digit pullbacks along the way. In 2006, similar turbulence occurred before the broader commodity complex peaked. Forward analysis must remain conditional. Historically, when silver breaks above a decade-long ceiling and the gold-to-silver ratio compresses, meaningfully, sustained uptrends have followed if global liquidity remains supportive. If industrial demand tied to renewable energy and electronics continues expanding, that underpins baseline consumption. If, however, central bank policy tightens aggressively and liquidity contracts, speculative components tend to retreat, extending consolidation. Three scenarios emerge from the data. In a conservative path, silver oscillates between the high 20s and low 30s as leverage resets and physical demand gradually absorbs supply. In a moderate continuation scenario, renewed inflows into ETFs combined with stable industrial consumption could retest recent highs and attempt structural continuation. In a more aggressive volatility expansion scenario, further margin shifts or macro shocks could drive another sharp pullback before any sustainable direction emerges. The key indicators to watch are open interest trends, ETF ounce holdings, margin requirement updates, and the gold-to-silver ratio's trajectory. This divide is not about intelligence, it is about attention. Those who focus only on daily price candles experience whiplash. Those who track structural metrics see context. Institutions always move first because they operate inside the plumbing of markets. Retail typically responds to price, not structure. That information gap often becomes a performance gap, not because one group is smarter, because one group reads the mechanics. Silver's recent volatility is not random chaos. It fits within a historical template repeated in 1980, 2006, and 2010. Breakouts from compression, leverage surge, margin response, violent retracement. Then either continuation or prolonged range depending on liquidity and demand conditions. This is not opinion. This is pattern. So the question is not whether silver is destined for immediate breakout or inevitable collapse. The data does not deal in destiny. It deals in probabilities shaped by structure. The question is whether the current volatility represents the reset phase typical of early-stage commodity cycles, or the exhaustion phase typical of late-stage speculation. That answer will not come from headlines. It will come from the next shifts in positioning data. This is market signal, where we decode what matters before it becomes consensus narrative. If this connected dots that felt disconnected before, you know what to do. The real divide is never about who hears the news first. It is about who understands the structure beneath it. And in markets, structure always speaks before price tells the full story.